Hello, friends. Today we're taking a look at Alphabet Inc., ticker symbol GOOGL, or also GOOG. They just reported this past Tuesday, and as you can see over here, the stock price have dropped almost 12% since that. So what we want to do today is I would like to look at the earnings just really quickly, then look at the past 10 years of financials, try to determine if it's a good stock to own, and then just try to find a fair price to pay for it, and then start thinking about maybe a margin of safety or so. So Google or Alphabet is the parent company of Google. They own Google. They also own Fitbit. They also own Google Nest, Pixel, YouTube, and they just reported this past Tuesday. And earnings, as you can see here, they went up. I believe here it says the revenues went up, change year over year of 11%. Operating income went up 28% compared with last year. Diluted EPS went from $1.06 to $1.55. And looking at where the revenue came, as you can see, almost every single item went up except Google Networks, that it went down a little bit, but everything else has been going up, and that is one of the reasons why I think that that this is a great company to invest on. Even here, operating income, Google Cloud, which is what a lot of people freaked out about, and now it's actually making profit. It was losing money, and now it's making profit. Here, when we read in Investopedia, we see that the main reason why Alphabet shares went down is because the Google Cloud revenue total 8.4 billion, which is roughly 2% below expectation of 8.6 billion. Come on. But it grew 22%. Come on. So that is one of those things that I just sometimes don't understand. But when people panic, when people have issues, this is the time in which we can jump in and take a good look at these companies and maybe be a buyer. So the question is, has it dropped enough for us to buy at $122? Is that a good entry price? So what we're going to do is we're going to be jumping in right here to my 10-year spreadsheet. And when we look at revenue, we are seeing that in the past 10 years, Google has been constantly bringing the revenue up, which is good. That's something that I like to see in the companies that I want to invest on. In the past 10 years, they have been growing at 18.2%, and 5 years, 19%. And this, it's awesome. When it comes to earnings, of course, 2021, which is a 2020 year, was a big year for them, just because everybody was home because of COVID. But even if we just ignore that, we can still see here that the net income keeps going up really nicely. In the past 10 years and the 5 years, they are between the 18 to 19%. So that's very constant. I like that. Also, their profit margin is $22. 22%, which means is for every $100 of revenue that they make, they keep $22, about $22 in profit. That is a really good margin. When it comes to free cash flows, once again, you can start seeing that it's growing nicely up at a 22% in the last 10 years CAGR, and the last 5 years has exploded 30%. And then their last 5 year free cash flow margins are at 21%. So once again, that means for every $100 that they make on sale, they make $21 of that. It becomes free cash flow, which is great. And book value has been growing steady, about at 11 to 12% a year. Return of equity average is 18%. Return to which I look for them to be above 15. Above 10 is good. Above 15 is great. Return of asset, I look for 5% over, and they're at 13%. That's great. Return of invested capital is at 14%. That's pretty good too. They don't pay a dividend, and their debt has grown a lot. But whenever you compare the amount of debt, which is like, I think it's like $2 a share, like the long-term share debt, whenever you compare it with the $6 that they make every single year, it means that, I mean, if they wanted to pay their debt, they could in less than a year. So I normally look for at least 5 years. So this is great, great numbers over here. When it comes to shares, they were going up all the way to 2018, and now they have been coming down. So they have been coming down faster at about 2% a year. But if you were to look at it in a 10-year CAGR is about less than 1%. So when it comes to the financials, in the past 5 years, they have grown in revenue about 20%, earnings about 19, free cash flows at 30, book value at 11, and analysts are projecting that in the next 5 years, based on they're projecting that they will continue to grow at a 20% on earning, 19% in earnings, so close to what they have been doing. So the average of all of those growth is about a 19 to 20%. So going forward, I'm going to use something a little bit more conservative to that, and I'll show you in a moment. Multiples. Whenever we look at the last 5 years, the trailing, we look at the last 10 years of multiples that they have been paying, and that we multiply them by the trailing 12 months and the average. That gives me an idea of what a fair price is. The problem with this multiple valuation is that it is good for most companies, but Google is growing so fast that whenever we average the last 5 years, it's going to create a very, very, very different number. That's why you will see, for example, here we're like an average of $5, but then in the past, if we add the $1.64 and the $2.22, it just really brings the average very low. So I will not be paying attention too much about the average because of how fast this company grows. So I'll be looking at somewhere between the trailing 12 months and the average. So I will be looking more as a fair based on multiples. If I had to choose one of these numbers, I will probably lean to the $140 being the fair price. Same thing here. I'm looking at if we were just to look at their cash back and using a 15%, if our free cash flow were to grow for the next 15 years at 15%, if we just hold it, a fair value will be about $343, which means we will receive that money back in 15 years, which, some people like this valuation, some people don't. I like it. The discounted earning valuation, it tells us that we will be looking at also at $140 fair value if we were to grow earnings at $15 and a average P, 50%, and an average P of 27, in which is the average of the last 10 years. I'm not going to be using the owner's earnings because what is happening with Google or Alphabet is, if you see the net income, their capital expenses have been eating up by, in the past years. It's quite an amount of capital expense, so that reduces the number down here, how much we're willing to pay, and the numbers have completely changed. So here, for example, is a $5 billion difference. Here is almost a third, maybe a little bit more. Then this is about half. This is about a quarter. This is about a half again. So I'm just going to ignore this one, and I just wanted to give you the explanation because I know that some of you guys that follow and like Warren Buffett, he talks about owner's earnings, and I just wanted to explain why I'm not going to be using it when I'm determining my fair value. So there's no dividends in there, and I'm just eliminating the owner's earnings. So that gives me a trailing 12-month fair value of $175, and the 5-year at 120. But like I explained, I think that this is too low because of how fast it's going. So I'm pretty much going to focus on this too. I feel a little more comfortable buying at the average, just because I do think that in the next 2 years, things are going to slow down. I'm guessing advertisement for Google is going to slow down, as we saw over here. Some of their income, I think that advertisement in YouTube is going to go down. That some of the other services that they provide, like advertisement, I think is going to go down, and some of the purchasing power that some people have with Fitbit or the phones, Pixel and stuff like that. I just think that that people are going to have less money to spend in the next 2 years. So that's why I chose the 15%. And I'm just going to be using this. So if you were looking at a 25% margin of safety, and right now the price is at 122. You could wait a little bit until it gets to 110. I bought a couple of shares whenever it dipped early in the year. I think I bought them at around $89. So I think I'm gonna wait until it gets under 90, and that's when, or maybe 105, somewhere around there, I'll start buying again. So those are my thoughts. I hope that you enjoy it. So from my perspective, I think that this is a good company to invest in the long term. And I personally will be looking at entering somewhere around 105. Remember, this is not investment advice. This is just my opinions. This is for educational purposes. I hope that you enjoy it. If you liked it, please subscribe and leave a like. And if you have anything that I probably miss, just write in the comments and I'll try to respond. Bye.